Hi, I'm Pia. I'm an economic researcher and I teach macroeconomics. In this video, we're going to learn about the monetary system and the Fed's tools for monetary control. In order to do so, we will define money as well as its main characteristics. Then, we're going to explore what the monetary system is about. Then, we'll talk about the monetary system's controllers, central banks, and the Fed. And finally, we will analyze the Fed's tools of monetary control. With this content, you'll be able to understand the objective and purpose of the Federal Reserve of the US. So let's begin. One of the main things we study in macroeconomics is transactions or trade. Ancient societies used barter as a means for trade. Afterwards, that was replaced with salt or gold. Nowadays, our system operates with people working in order to make money. That money is used to pay for our bills, go to the supermarket, to the cinema, or to the restaurant. As we know, when we want to buy or pay for something, we exchange it for money. But how is it that money is represented in paper bills and coins? Who controls this? Let's begin with analyzing the monetary system. The monetary system is about how money flows and is applied in order to carry out these transactions. Money is defined as assets that individuals commonly use to purchase goods and services from others in an economy. Money has certain qualities that make the monetary system work. Those are the following. It's a medium of exchange, which means it's commonly accepted by everyone. If you want an ice cream and ask to pay for it in bottles of water, you probably won't be able to buy it. However, if you offer enough money, then you'll be able to carry it out. Money is also a unit of account. We just said that if you offer enough money, you will be able to buy an ice cream. This has to do with the fact that every item has a price and is measured in dollars or the local currency from each country. If an ice cream cone is $1 and you have $1, then you will be able to buy it. Even though $1 can also be worth one bottle of water, we trade with money. Money can be used as a store of value. This means that people can transfer purchasing power from the present to the future. In other words, the money that I have now can be used tomorrow or later on for buying, for example, a meal. And finally, money is liquid. That means that if I have money, I can now use it for purchasing items. Going back to the ice cream example, I won't be able to make the purchase with bonds or gold. I will need money. These last two characteristics are very important because if we keep money in our pockets, we may notice that it will lose value over time, since we will be able to buy less goods than before. So every person makes a decision when using money, because they can decide to save it and use it for the future, or use it now for consumption. The monetary system also evaluates these issues, because in order for money to continue being accepted as a store of value or as a liquid asset, it must conserve its value as much as possible. Now, we're going to see which assets count as money. But first, let me ask you a question. Do credit cards count as money? If your answer is no, then you are correct. Credit cards do not count as money. They are a deferred method of payment. Even though we can pay for things with credit cards, we eventually pay for the amount in money. The only thing that changed is that the payment was delayed. So, what assets represent money in the US? We have two big compounds, M1 and M2. M1 consists mainly on circulating currency, which are paper bills and coins, and checkable deposits. If we add savings accounts, small-time deposits, and money market mutual funds, then we get to M2. Those assets are what compose the monetary system. And now, who controls it and why? Central banks are the public authorities created in order to control the monetary system. In the United States, the central bank is the Federal Reserve, or the Fed. Its authorities, who are appointed every 14 years, are independent from politics and the government. The Fed has the role of controlling the banking system as well as regulating the money supply. The banking system is composed by all the banks that operate in an economy. As we know, banks operate as lenders and borrowers. We can lend money to the bank by making a deposit, and then the bank will repay it with interests. And the opposite happens when we borrow money from the bank. We repay that money with the addition of an interest rate. Since banks handle such delicate operations, they need to be regulated and controlled, and that is done by the Fed. The Fed, first of all, is a lender of last resort, which means that it provides safety and liquidity to banks. The money supply is the quantity of money available in an economy. By available, we mean that it's circulating, which is what we previously defined as M1 and M2. The Fed controls the money supply, which means that it's in charge of the money creation. However, even though there can be more or less money in circulation, banks or people may not respond to that. For example, if there is more money supply, it is not certain that people will start using more money. But why does the Fed need to regulate money supply? The Fed, as we've just seen, has the capacity of creating money, but that capacity has its own limitations. Imagine that the Fed created money endlessly. Would it still be able to possess value? In macroeconomics, we analyze the operation of many markets. Money has its own markets, which means there is a money supply established by the Fed. But also, there is a demand for that money. If the money supply exceeds the demand, then its value will decrease. This has to do with the quantitative theory of money. Other example happens when countries experience economic growth. When output increases, it can also generate growth in employment, wages, and consumption. That leads to an increase in the demand for money and, in many cases, in prices. This short-term trade-off between inflation and unemployment is studied with the Phillips curve. Both examples account for inflation, which is an overall and sustained increase on average prices. This is a big issue since it generates loss of purchasing power, especially for the poorest sectors of the population. The Fed plays a key role on mitigating this effect, since it needs to control the money supply so as to avoid inflation. This means that the money supply can respond to the demand, but not excessively. So, how does the Fed apply these mechanisms? The Fed has its own tools of monetary control. This is what we know as monetary policy. There are three kinds of monetary policy. First of all, we have the open market operations, which consist on the Fed buying or selling treasury or government bonds. How does this affect money supply? Picture that the Fed starts to buy treasury bonds from US citizens. Those people will stop having an asset that's not liquid. They will start having money in their pockets. In order to stimulate people from selling the bonds, the Fed might control the interest rate so as to make selling more attractive and multiply its effect. That is one way of increasing money supply. If the Fed wants to sell the bonds, then people will start having less money in their pockets, which leads to a decrease in money supply. Another tool is the regulation of reserve requirements for banks. In order to ensure banks' liquidity, the Fed establishes a minimum amount of reserves that banks must hold against deposits. This is a percentage rate of the money that the bank's using and has to be kept and not circulated. This tool, as you may see, is also useful for assuring that banks keep a reasonable amount of money available in case many people make withdrawals at the same time. So, for example, if the Fed increases this rate, it means it's demanding that banks withdraw money from circulation. In other words, it's decreasing money supply. The third tool is the discount rate, which stands for the interest rate on the loans that the Fed makes to banks. If the Fed increases this rate, it means that it will be more costly for banks to ask for loans to the Fed, which means there will be less liquid and money will circulate slower. On the other hand, if the rate decreases, it means money is more accessible for banks and there are more chances of increasing its circulation. With everything we've just covered, it's time for another exercise. After a boost on aggregate demand, it is likely for prices to rise and cause inflation. You work as an economic advisor at the Fed, and the staff is evaluating to apply monetary policy to counter this effect. Which option would you suggest the table? A. Perform an open market operation by buying treasury bonds. B. Lowering the reserve requirement for banks. C. Decreasing the discount rate. If your answer was A, then you are correct. Since prices are expected to rise, the Fed seeks to withdraw money from circulation. The only option that decreases money supply is selling treasury bonds, since people use money from their pockets in exchange for an asset that's not liquid. Options B and C, decreasing the discount rate or the reserve requirement, are not correct since they are policies that aim to increase money supply. Which are the most common mistakes? Remember, not every method of payment is money. For example, credit cards do not represent money. Also, even though the Fed has the capacity of money creation, it doesn't mean that the money supply is unlimited. Actually, quite the opposite. The Fed has to regulate money supply in order to comply with money demand, but avoiding inflation at the same time. So, to wrap up, the monetary system stands for how money flows and is applied in order to carry out every transaction in an economy. In the US, it's regulated by the Fed, who controls banks and money supply with monetary policy. So with this video, you have learned about how the monetary system works and the purpose of central banks. Hope you have enjoyed it, and also, if you want to learn more, feel free to explore more about the topic on Chegg.